We can readily incorporate systematic risk in our project evaluation decisions via the required rate of return. However, there can still be a considerable amount of uncertainty concerning our forecasts of certain variables in our decision-making criteria. Just because the calculated NPV for a proposed project is positive, we are not sure 100% that everything is going to turn out well for our project. What if we made a mistake in the estimation of cash flow? How reliable then is our NPV calculation? The cash flow used in our NPV calculations are based on different probable outcomes, different possibilities. Thus, the figures used in computation are an average of those possible outcomes. In real life, the actual cash flows derived by the project could be higher or lower than that average. Managers know that, and they expect the actual cash flows to differ from the projected cash flows, and that's why they take an average of those possible future outcomes. However, what they don't want is a major estimation error that will result in wrong decision. What they don't want is to accept a project that in reality has a negative NPV. On the other hand, they don't want to miss out on a project that we incorrectly rejected, when in reality has a positive NPV. These kinds of errors are called forecasting risk, the possibility of an incorrect decision due to errors in cash flow projections. So how can we identify the areas where potential errors can be made? One way of analyzing uncertainty is to check to see how sensitive the NPV, IRR, etc. are to changes in the key assumptions. We perform sensitivity analysis where NPV is calculated when only one variable is changed. Bear in mind that in the real world, variables move together. The objective of this analysis is that we make better decisions, not churn out more tables and numbers. In scenario analysis, the NPV is evaluated when more than one variable are changed. And in simulation analysis, it's a combination of scenario and sensitivity analysis performed by computers. This is an example of sensitivity analysis. We have this company considering a new project that cost $7 million initially. When it's up and running, the project will sell 500,000 units, with sales increasing by 5% per year. The company expects to capture 5% of the market in the first year and then increase its market share by 1% after. The selling price per unit will be $200 in year 1, which will decline by 10% per year after that. All production costs are variable and equal 60% of the selling price. GTI's marginal tax rate is 30% and the appropriate discount rate is 14%. Considering all these inputs for each year, we calculate a mini income statement, then estimate the cash flows for each year, and then discount those cash flows at 14% to arrive at an NPV, which is $236,000. We call this the base case NPV. Sensitivity analysis involves calculating the NPV for various deviations from the base case set of assumptions, a pessimistic or an optimistic case. It allows managers to test the impact of each assumption underlying a forecast. For example, what if the selling price is less at $175 in the pessimistic case? We see that NPV is negative then, at minus $488,000. Or what if the variable costs are lower, only 58%, not 60% of sales? That would be an optimistic case, and we observe that the NPV is higher than the base case. It's higher at $526,000. Scenario analysis is a more complex form of sensitivity analysis. Rather than adjust one assumption up or down, analysts calculate the project NPV when a whole set of assumptions change in a particular way. For example, if consumer interest in GTI's new skateboard is low, then not only the project may achieve a lower market share, but also a lower selling price than originally anticipated. Simulation analysis, like Monte Carlo simulation for example, uses probability distributions and is performed with the aid of computer programs, where the program randomly selects values for each variable from a specified range of distributions and calculates the NPV. This process is repeated many times, like say 1,000 times, and is supposed to give us a better indication of the likelihood that the project will be successful, or the chance or the probability that will be unsuccessful. For example, the manager may specify that the market share can be anywhere between 1 and 10%, or that the selling price of GTI product is a random value with a mean of 200 and standard deviation of 30. The software then takes these random draws from the distribution and calculates the project's cash flows and NPV over and over again. The end result is a probability distribution of projects' NPVs rather than a single point estimate of the expected NPV. Also, this analysis tells us the likelihood that the project will be successful or unsuccessful, or the chance that the NPV will be positive or negative. This kind of analysis is becoming more popular as technology and computers are more advanced and sophisticated, and is used mostly for large-scale projects where there's a lot of money involved and the management doesn't want to have a large forecasting risk. Another technique that helps managers with their capital budgeting decisions is to draw a decision tree with all the possible outcomes for making different choices. A decision tree is a visual representation of the sequential choices that managers face over time with regard to a particular investment. And it has the advantage that it forces managers to think through their decisions and how they will react as future unfolds. The process in a decision tree analysis is as follows. First, we estimate the probability at each branch of the tree for each period. Then we calculate the joint probability for each potential path. Then we find the NPV for each path, and then we calculate the expected NPV. For example, Russian Foods Limited has invented a new product, a salt substitute branded Odessa. The company is deciding whether to spend 5 million Australian dollars to test market a new line of potato chips flavored with Odessa in Perth. If the outcome of the test is good, Russian Foods may spend an additional $50 million a year later to launch a full line of snack foods across Australia. Then, if consumer acceptance is high, the company predicts that the product will generate a cash inflow of $12 million per year for the next 10 years. On the other hand, if consumer sentiment is low, cash flows are expected to be just $2 million per year. Their cost of capital, or the required rate of return, is 15%. To work through a decision tree, begin at the end and then work backwards to the initial decision. If the test market is successful, the NPV of launching the product is $10.23 million. However, if the initial test results are negative and the company launches the product anyway, it will have an NPV of negative $39.96 million. By working backwards from right to left on the tree, Russian Foods can decide whether to conduct the test in the first place. The expected NPV is the weighted average of the discounted NPVs of the positive NPV 10.23 million and the zero NPV when we don't take the test. We then evaluate today's decisions about whether to spend the initial 5 million in testing. We decide that spending the money for market testing does not appear worthwhile. One of the most significant advances in corporate finance theory and practice in the past few decades has been real options. When we think about options, most of us think of financial options, which have been around for some time. A financial option is a contract that gives the buyer the right but not the obligation to buy or to sell a share, a bond, etc. at a given price upon payment of a premium to the seller. It was recognized then that options could offer a valuable insight into the real world of corporate finance, and that brought about the application into capital budgeting. A static discounted cash flow analysis ignores the management ability to modify the project as events occur after the project is accepted. Managerial options are opportunities that managers can exploit if certain things happen in the future. A real option is an option to change the real physical or intellectual activity of a business. There are a number of these options. For example, a product's pricing, manufacturing, and advertising can all be changed after the product is launched, or a brand new technology or other additional output can be introduced in the same project to enhance the NPV of the project. A real option is then effectively a deal between the firm and the outside world. Because these deals are key to business success or failure, they need to be actively managed and valued also. For example, a new motel project is expected to provide a single payoff in 1 year after construction. If the motel is popular, the cash flow is 13 million, and if it's unpopular, the cash flow is 9 million. The probability of both outcomes are equal. The cost of the motel is 9.7 million and the discount rate is 10%. Here we have the results of the decision tree NPV. The technique evaluates this project by its expected value by multiplying the cash flow with the probability of occurring. Here the expected value of the cash flow is 11 million, which is made of 13 million times 0.5 probability plus 9 million times 0.5 probability. And discounting this at 10% discount rate gives us a present value of cash flows of 10 million. If the current construction cost is 9.7 million, then the project's NPV is 0.3 million. As the NPV is greater than 0, we would accept this project. We see this approach deals with the risk and timing of cash flow, but it does not deal with the management's ability to time its decisions to take advantage of the risky cash flows. In fact, management has the option to wait a year or more before deciding on construction. Let's assume the management just waits 1 more year. Uncertainty generally decreases with time, so we can weight the primary uncertainty in the market during this next year and then decide on an investment at that time. If these types of motels turn out to be unpopular, then it would make little sense to invest 9.7 million to make 9 million a year later. the NPV will be negative at 1.52 million. However, if the market turns out to be attractive, then a 13 million payoff in the next year would provide an NPV of 2.12 million, a positive NPV. Thus, the expected values of the two outcomes incorporating the option to delay the decision is 1.06 million. Discounted back at 10%, the expected NPV is 0.96 million. Obviously, the option to wait until next year to decide has value because the NPV is higher than if we were obliged to invest now or never. By ignoring this valuable option, we could have invested too early and missed the opportunity to add shareholder value. The basic static NPV approach assumes that management's role is passive, even with the most extreme outcomes. If management can actively respond to surprises and avoid negative NPV's outcomes, the true value of its opportunities will be higher than basic NPV calculation would suggest. The examples of real options are option to expand, which means if the project is successful, is it possible to increase production and expand? If we fail to take in consideration this, we underestimate the NPV. Then we have option to abandon. If the project does not break even, we can scale down or abandon it. It would be better to just invest the money somewhere else. Follow-on investment options are similar to expansion options, which entitles the company to make additional investments to enhance the original project if it was successful. For example, by purchasing the rights to make a sequel, the movie studio has the right to make additional investment if and only if the original movie turns out to be a success. Flexibility options give the company the ability to use multiple production inputs or produce multiple outputs. For example, a production equipment can switch between oil and gas fuel, or a refinery that can use the same basic plant can produce different types of fuel. Then we have the option to wait. This means that even if the project has positive NPV, it might be better to wait until economic conditions improve. In an increasingly competitive global environment, real options are an important dimension of firm decision making and help to explain recent business activity. This concludes this module.